Hello and welcome to this session in which we would look at the different forms of business structure. When you operate a business, you could operate a business by yourself as a sole proprietorship, you could operate a business with your friend, forming a partnership, or you can incorporate, start a corporation, and operate your business as a corporation. So the firm, any type of business, any firm can organize itself in any different way. However, you have to keep in mind the way you organize your business will influence how much taxes you pay, the liabilities, personal and business liability, as well as challenges of raising money. So a firm organizes activity and addresses the fundamental challenge of raising capital. So you have many types of organization. The corporate form of business is the standard method. So large corporation in the United States, they are corporations, specifically C as in Charlie Corporation, because we have C Corporation and we have S as in Sam Corporation. In this course, we don't discuss S as in Sam Corporation. S Corporation is for tax purposes. It's beyond the scope of this course. If you're interested, go to my Farhat lectures and look at my income tax course to learn about S. C Corporation is the standard corporation when you think about Walmart, Apple Computers, IBM. Those are C Corporation. Other legal form of business exists in the US, and we'll explore three main forms under capital raising approaches. One is a sole proprietorship, so you could start a business by yourself, sole. Two, a partnership. Partnership is 2+. You could have 2+ many other people, or you could form a corporation. A corporation could have one owner. A corporation could have 1 million owner. It does not really matter. And when we discuss corporation here, we will assume it's public. Public means anyone can buy the stock. We have public and we have private. So we would assume we are dealing with public corporation. So in this session, we would look at the three forms of business structure, legal business structure. I will briefly discuss advantages and disadvantages of each. Now keep in mind, this topic is very common in various courses. For example, this is a finance course. I covered this topic in my introduction to accounting or financial accounting. I covered this topic in my business law course. I covered this topic when I cover C and S Corporation in my tax course. So notice this topic is repeatedly covered. So this is basic knowledge before you graduate from college. And I'm pretty sure you learn about this topic in your management course. So it's something that you need to be very familiar with. We're going to go ahead and discuss each type of legal structure, starting with sole proprietorship. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here. Sole. When you say the word sole, it means one individual. It's an entrepreneur, sole proprietorship. It's a business owned by one person. That's by definition, sole is one. An individual starts a mousetrap business and assumes all roles and risk. What are some key features of a sole proprietorship? The first one is ease of formation. What does that mean? It means you don't have to file paperwork with the government. In the US, none whatsoever. If you want to start a business, you just start a business and you're a sole proprietorship. No formal charter required. You don't need to talk to a lawyer. You don't need to do anything like that. So one of the advantages is ease of formation. Two, it's tax simplicity. When you operate a business as a sole proprietorship, you are the business. It means there's no business. The person is the business. Therefore, there's no corporate taxes. The profit that you make in this business is taxed as you are, as personal income, because there's no corporation involved. It's a sole proprietorship. You are as the business. Now, those are good stuff, right? Third thing, unlimited liability. This is no good. What is that? Owner is fully liable, fully liable. Personal and business asset are not separated. So what happened when you operate a business as a sole proprietorship? You and the business are the same individual. So what does that mean? It means if the business is sued for any reason, somebody walked into your store and slipped, you broke a contract, whatever the reason, you are sued. There's no business. You are sued yourself as an individual, and that's dangerous. Why? Because if you lose, they can come after you. The other party can come after your personal property, personal car, personal home, personal belonging. It does not matter. There's no business here. The business is you. And this is a disadvantage. Limited life. When you are by yourself, and for one reason or another, you die, you go to jail. Hopefully, I hope not. We're all gonna die, but you don't want to go to jail. Or whatever the reason, once you cease to exist, the business ceases to exist, because with the owner's death or exit, that's it. The business is done. There's a limited life. Limited equity. Funding is limited to the owner's personal wealth and trust and personal idea. When you want to raise money, whoever's going to judge your business, they are going to judge you personally. So if I want to raise money for Farhat Lectures, for my company, whoever wants to invest in my business, I'm not a sole proprietorship. I operate as an S as in Sam Corporation. But as I mentioned, S Corporation, it's kind of a corporation, but it's for tax purposes. They will evaluate me because I am the business. I'm the sole owner of the corporation anyway. So they would have to look at my ability, at my potential before they invest in you. Versus if you have many investors, then you diversify that outlook. But you have limited equity in that sense. But also it could work to your advantage if you have a good business idea and you need money to grow it. So, but we can say it's limited equity, giving everything else as equal. So that's one way to operate a business, to run a business. Partnership is another way to operate the business. The partnership, you need 2+, so you cannot have one person. It's a business owned by 2 or more individuals. You could be 50 and form a partnership. There are 2 main types of partnership. 2 main. There are more than 2. But for this purpose, we only discuss the 2 main type. In my business law lectures for the CPA exam, you'd have to break them down further. But for our purposes, we assume we have a general partnership. And for a general partnership, here's what I want you to think. It's a bunch of sole proprietorship working together. So there is no formal paperwork, none like that. All partners share in the work, profit, loss, and liability. So it's a bunch of sole proprietorship working together. The other type of partnership is limited partnership. Limited partnership will have both limited partners, I'm going to call them LP. We're going to have limited partners and general partners. Limited and general. You have to have limited partner and a general partner. So when would you form a limited partnership? A limited partnership is formed when someone with money and someone with a great business idea. Now, this individual with a great business idea, they need money. So they would go to another partner and say, I have this excellent idea, but I need money. The limited partner, they have money, but they don't understand the business well. They would say, okay, I will invest money in this partnership, but I want to be a limited partner. Now, why do you want to be a limited partner? Because you want to have limited liability. So let's assume you invested in this business $50,000. Now, the maximum you would lose is $50,000. Your liability is limited. How about the general partner? They would lose all. They would lose their money that they invested in the business, and they would lose their personal money. So a partnership, if it's a limited partnership, you could have many LPs. You could have many LPs, but you need for the general partnership to exist, you need one general partner because you need someone to take the blame. This is what a limited partnership will not exist without one general partner because someone will have to take the fall. So limited partners' liability is restricted to their contribution, and they typically do not manage the business. So as a limited partner, you have no saying. You try to stay away. Try to stay away from the business because if you get involved, you could be exposed in terms of liability. But a general partnership, everybody is exposed. Everybody is exposed to unlimited liability. Everybody is responsible for the personal with their personal asset. Partnership agreement. Do you need a partnership agreement for a general partnership? Not really. You can, but you don't need it. For a limited partnership, I would say yes. I would say yes in limited partnership to emphasize that you are a limited partner. But for a general, let's take a look at this multiple choice question from farhatlectures.com. All the following are advantages of forming a corporation except. So we have 4 options. 3 is yes, 1 is no, and we're looking for the no. Well, let's eliminate the yeses. Easy, okay, because there are 3 of them. The shareholder liability is limited to the amount invested. Well, that's a good answer as an advantage, therefore I could eliminate it. As a shareholder in a company, you have a limited liability. A corporation exists beyond the death of managers, board of directors, and executives. Absolutely. The corporation can exist in perpetuity. Even if all of these died away, the shareholders can replace them. So that's an advantage. It's relatively easy to raise capital. Yes, it's relatively easy to raise capital. Why? Because if somebody wants to invest in you, they can simply buy your stock. So from a mechanical perspective, from a logistical perspective, is relatively easy to raise capital, yes. So by process of elimination, D is the answer. It results in double taxation of income. The answer is true, yes, but this is not an advantage. Remember, this is a disadvantage. So all the following are advantages except it results in double taxation. That's a disadvantage. What should you do now? Go to Farhat Lectures, look at additional resources, multiple choice, lectures that will help you, whether you are a finance student studying for a professional certification, CPA, CMA, CIA, CFA, it does not matter. Invest in yourself. That's the best investment you can make, and good luck.